Welcome to the Hassle-Free RE Podcast, a real estate podcast where we bring you stories, education, and tips for investors and real estate enthusiasts. If you're interested in investing in real estate or just want to keep a pulse on what's happening in the market, then this podcast is for you. Thanks so much for listening and tuning in. If you enjoy our show, please make sure to subscribe and give us a 5-star review. We'd greatly appreciate it. This podcast is brought to you by the 5-Star Co-Host, an Airbnb management and consulting company that helps homeowners turn their properties into passive income streams through short-term rentals. Do you want to turn your vacation house into a passive income stream? Then look no further. The 5-Star Co-Host has served over 1,000 guests in several Airbnb properties and in varying markets. The 5-Star Co-Host is at the vanguard of the short-term rental industry by leveraging technology and systems to maximize the guest experience while achieving high revenue for owners. Get a free home analysis by emailing the 5-Star Co-Host at gmail.com. That's the 5-Star Co-Host at gmail.com. THEFIVESTARCOHOST at gmail.com. Thanks, and I hope you enjoy the show. Hello, everyone, and welcome to the Hassle-Free RE podcast. I am David Menapace.
And I'm Kim Menapace.
And we are actually sitting right next to each other here. Kim, tell everyone what we're going to talk about today.
Yeah, so we've had folks that are listening to our podcast ask about how do you actually run an Airbnb after you've already selected your house to purchase, you're already underway. So what you have money coming in, you have expenses coming out. What are the nuts and bolts of actually managing a short-term rental yourself? So we thought we'd give a little glimpse into what that was like the last 3 years or so when we were managing just one property, and just share some knowledge and some mistakes we've made along the way and managing our first short-term rental.
So we have conveniently named this podcast, and it'll actually be a YouTube that we put as a podcast because there's going to be some visuals, but we'll talk through them. We've called this Financial Management of a Short-Term Rental. So with that, why don't we jump right in?
Okay. So in another podcast, we already covered the buying, furnishing, getting your emergency fund underway, part of a short-term rental. So we really want to cover the next steps for that. So that's banking, managing all your receipts that are coming in and out from both furnishing it and then also the supplies that you need along the way while you're hosting people at your property. The tracking of expenses and revenue income coming in from Airbnb and VRBO. The tax side of things and permits, we'll just lightly touch on that and give you that working knowledge you need there. And then lastly, on forecasting and planning ahead for anticipating how much you're going to be making and then planning for those improvements and maybe capital expenditures that are coming in the next few years.
And this is, or if you could go back for a sec. This is definitely, not the sexiest part about having a short-term rental. But what we've found is that these sort of back office tasks or components, or really these back office activities, help a lot during tax season. I mean, one of the benefits of investing in real estate in general are some of the tax opportunities that you get. So this sort of helps set you up for success in that fashion. But also, if you're somebody that down the road might want to buy a second vacation home that you'd like to rent out, having these sort of activities dialed in really makes the launching of a second home at any point in the future a lot easier. Especially as we get into a little bit with tracking expenses and revenue and then forecasting that out, that's really where you start to become what we call a 90th percentile performing short-term rental. So we'll get into that more when we get to that part.
I don't know what you're talking about. I love this part of managing a short-term rental. I'm a nerd and I like Excel spreadsheets and being super organized. So
have you heard this is really funny. So Ashley Kerr is one of the hosts of the Bigger Pockets rookie Bigger Pockets Real Estate Rookie podcast, and she always says, what is it? A lady in the streets, a freak in the spreadsheets. That's what it was. And I always think that's really funny. It took me a minute. All right, why don't we jump right in? Banking.
All right, so banking. So you already have your house under contract. You're getting excited about purchasing all the decor and the bedding, et cetera. So this is something that we did not do well with our properties that we highly recommend that you should do. Go and set up a checking account and a savings account. That's also something that we recommend, but especially a checking account for your property. Put money into that and then make your purchases all from there. It makes your receipt reconciliation so much easier later. Along those lines, I'd also recommend dedicating a credit card to that property and using it exclusively for that property, either getting a net new one or one that you don't use frequently and just allocating it for that property. It's going to save you a lot of headaches down the road if you do that.
Can I add some color to this in that it costs nothing to set up at least the checking account. Maybe it takes an hour of your time. It is not a bad idea to do this before you even close on the property, because you're going to start wanting to buy things when you're in escrow under contract or right after you close. And to add a little bit of color to this as well, I read a stat. I think the CEO of Minoan said this, that on average, when you're launching a short-term rental, you make about 200 purchases, even
for a 2-bedroom.
What's that?
For a 2-bedroom.
And that's for a two or three bedroom there, 2 bedrooms. So just think about that. If you're, and I would say that we've at least made that, at least just looking more closely at our recent in Maine. And so the lesson I learned is that I had expenses across several checking accounts and 1, maybe 2 credit cards. And then going over that with our CPA and having Kim reconcile all of those receipts has taken hours and hours and hours and weekends and you name it. So it's a simple trick that's going to make your life and your CPA's life a lot easier, so you can maximize the benefit of the tax write-offs.
Yeah, so that's what we would recommend at a minimum. Some next steps after that, I'd say that savings account is really helpful, especially as you start to plan more advanced things, building your emergency fund, maybe potentially saving for your next short-term rental. So that's definitely another step in the banking process that we would recommend, is a savings account that's accessible. It's from the same bank for that checking account. And then getting more advanced, there you can automate contributions to those accounts, and we'll go into that a little bit more. Dave and I recently, I'd say in the last year or so, we read Avery Carl's book, Short-Term Rental, Long-Term Wealth. And she had talked about the process for allocating funds from your revenue from Airbnb and VRBO and allocating them to particular purposes. So, and her recommendation was, hey, you have that checking account where all the deposits from your stays gets deposited into. Then you use that to restock items like paper goods, toilet paper and paper towels, etc., and use that for all of those purposes. She then recommended you create 4 other accounts. So one for taxes, one for capital expenditures, another one for cash reserves, which we've talked about before, an emergency fund, and then the last one for profit. So a little bit more detail about those. So for taxes, you will have 1099s for your booking for each booking platform that you list with. So we receive one at the end of the year for Airbnb and VRBO. For those, we don't actually have a bank account for taxes because the Airbnb and VRBO remit our taxes for us for our properties. So both for Massachusetts, where our property is in Cape Cod, and for Maine. So we don't have that checking account because we don't have to remit it ourselves. I think our first booking ever on Airbnb, we did. They hadn't done that. Airbnb wasn't updated yet to do that. So we had to do that ourselves. But every booking after that, we've been able to do to have Airbnb and VRBO take care of the taxes.
Yeah, I think you nailed it.
All right. Then for capital expenditures, something else we touched upon in previous podcasts was being able to set aside money for that roof that needs to be replaced, or that hot water heater, all those maintenance items that you know are going to come, and you should be doing this for your primary home anyways. So it's a similar thought process here, in that you want to allocate some amount of your revenue for those bigger expenses that you know you're going to need to invest in the future. Cash reserves or emergency fund, again, you really want to have about 6 months of your expenses saved up in an account. So say COVID happens, or something else comes, or you just run into some challenges with regulation in your particular area, and you need to be able to sustain those headwinds that are coming. So you really just want to have that, so you don't feel really like your back is against a wall if you have an issue come up and you can't make earn any revenue for a period of time. And then for profit, this could be for purchasing your next rental, could be for a major upgrade. You want to do a renovation on your short-term rental, or it could be paying back some credit that you leverage to be able to purchase that one, like we used our HELOC for our second property. So whatever this is just her framework on recommendations on how you break out your your revenue into different purposes from there. And she provided some percentages that she uses, and I'm not married to these. I think that I see some challenges. I think most people can't achieve these percentages unless you have very high equity in your house and really low mortgage. I think it'd be challenging to hit these percentages. But for Avery Carl's recommendation for the amount of money that stays in that revenue account where Airbnb deposits into, and where you pull out money to pay for your utilities and paper goods, etc., is about 22%. She recommended 30% for your taxes, 3% for capital expenditures. She said this could go up or down based on how old your house is. So we have our house in the Cape is 100 years old. So that one we might want to, allocate a little bit more. For example, your cash reserves, she recommends as a benchmark 20% until you hit that 6 month reserves. And then for profit, about 25%. So from our perspective, the 22% in the revenue account is not realistic for our properties. And I am hard pressed to find if that would work for most people that we talk to who are active investors in short-term rentals. So don't feel bad if that's not where you're at. If you run your numbers and are planning to purchase a property you already have, we want to just note that that's we haven't seen that be super realistic in our experience. Anything to add?
Yeah, I mean, revenue and profit are, somewhat similar, but I think usually, just to hit your numbers in general, it is nice if you, and again, depending on what your goals are, but from just a pure investment perspective, whatever you end up netting, whether you're calling it profit and that's getting saved for your next investment or what have you, it is nice if you're seeing about a 20%, monthly, you're seeing 20% on that. But if you were to take hers and add those, that's almost 50% going to that. So it all depends on where you're at, what you got the house for. It very well could be possible, just sort of depends, what your value add is, if you bird or any of those good things. So
yeah, and I will note Avery Carl, the author of this book, is a very advanced, savvy short-term rental investor who's been doing it for a number of years, as an agent herself, has a team of agents, and she owns her own brokerage. So definitely someone who's on that end of that spectrum. So just good to be mindful of that. Then did you want to add something?
No, you can go.
All right. So lastly, on the capital expenditures, cash reserves, and profit, for these, we're constantly advancing what our ideal percentages would be to contribute to these. So I think that once you get to a place of stabilization with your property, it's a little bit more a little easier to be able to appropriately allocate to each of those efforts. But it does take, we'd say, probably at least a year to be able to get to a good place of understanding what your ebb and flow of your expenses is, what your bookings are, and knowing your first year is probably going to be your lowest revenue, and you're going to slowly build up from there, even marginally, as we found with our properties.
Lowest revenue and highest expense in year one, for sure. Yes. I think whenever you buy a property, you really want to try and look out more like 3 to 5 years. Mm-hmm. And to Kim's point, a 2-bedroom house in Cape Cod is going to have far fewer capital expenditures than a 4-bedroom house in Maine that's on a well, and it has, it just has more expenditures that you're going to need. So it's like, when we look at this, I would say, just realistically, looking back at our last 3 years, we've probably put the most money into CapEx and repairs and maintenance. But at the same time, as we start to look out at what the next 5 years look at, just on the properties we have, there's a line of sight to seeing a higher, more stabilized revenue and a lower, more stabilized expense year after year. But it is smart to be proactive about it. It probably matters less what your percentages are, especially as it relates to CapEx, cash reserves, and your net profit, as long as you're being mindful of those 3 areas, and not just, taking that money to supplement your own personal income and then not planning for the future at all.
Yeah, and to add to the capital expenditures we've been investing in, I see it as both offense and defense. We're augmenting the value of our property, and we're also minimizing the chance of problems with guests. So we would hate for the hot water heater to blow right in the middle of our peak season in the summer in the Cape, and we have to refund someone a whole week rental. So that's what we mean by it's worth doing those capital expenditure improvements, and realize that they're twofold benefits to it. It can really prevent you from having some major headaches if you plan accordingly on those. All right, should we move on to the next one? So receipts and tracking. So for the individual that's just trying to get one short-term rental and is not, doesn't have goals to expand beyond that, I think that saving all your receipts on the cloud, and we use Google Drive for ours as a backup, is perfectly fine. I think with one property, that is a perfectly reasonable system. When you get to 2 or more, and even one, if you're really savvy with QuickBooks, you can do that. But when you get to 2 or more properties, you do need to step up your game. And we found that QuickBooks has been really important for us, and especially with our CPA, to try to save her time and have us do our proper tracking and bookkeeping on a regular basis there. So that's golden rule here: save all your receipts, take photos of them, upload them to the cloud as a backup, and just be super diligent to do that regularly, and not save them all to the end of the month, the quarter, the year, because it's just going to take you a lot of time and not be very fun there.
Yeah. Yep. Kim is our CFO for our business. So I'm usually the one that makes a mess, and Kim has to clean it up. But yeah.
And I didn't major in accounting, but I'm learning a lot more about, I'm going back 14, 15 years to my accounting classes in undergrad to learn this stuff again, but it's been fun.
And share with somebody why they would even want to keep as many receipts as possible.
So there's a few reasons. One, we use those to validate against the next thing I was going to go into, which is our tracking of expenses and revenue. We have a Google sheet where we track all of those things. So having those records is really helpful. You want them because you can write off your all the furnishings you did, the supplies you buy. We'll augment our cleaning supplies and buy a Dyson vacuum for our properties, things like that. So you can write all that off. And if you ever get audited and they see something, a little bit fishy in your tax filings, you have that if you get called on and have to show proof of all those things. So that if you have that record, it just makes that process go a lot smoothly, seamlessly, and hopefully there's no issues, and they can move on to their next case there. So I say, is that where you were getting at with that?
Yeah. No, you're exactly right. And to learn a little bit more about that, our episodes 10 and 11, where we interview Ryan Bakey, who's a CPA, he gets into that in a little bit more detail as to why you are allowed to have these write-offs and how that all works. But it is, other than having a good listing, for Airbnb and VRBO, on this side of things, having a system for holding onto your receipts is super important. Mm-hmm. So
Yep, I have a ton of photos from Dave from his expense for his expense tracking to go file those. And so again, with these expenses and revenue tracking, that we have a very simple Google sheet for doing this. And when you get to that 2 or more properties, we do recommend QuickBooks again for an easy way to I wouldn't say easy, because I think my learning curve has been a little steeper than I thought, but a more streamlined way, I should say, to be able to track those things and generate some of these financial documents that are really helpful for your CPA and if you ever get audited.
And if anybody wants a copy or a template of that spreadsheet, we're happy to template it and send it to you. It's super simple. We could make a 30-second loom on how to use it and send that to you. So just reach out and we'll be happy to do so.
All right, great. All right, so the next topic we want to go into is taxes and permitting. So permits are required in some markets. It is required in Cape Cod, for example. We have not found that it is required in the Sunday River area where our other property is up in Bethel, Maine. So it's I think a $50 charge. They just want to make sure you're letting them know you're going to be renting your property. They want to make sure your smoke alarms are working, and they want to also ensure that you are only advertising to rent for the number of people that are allowed in your property, given the number of bedrooms you have. So we have a 2-bedroom, we're only allowed to host 4 people. And that's because we're on a septic system instead of sewer that gets a little bit easier to rent to more people or expand your bedrooms. But for us, we are bound to the number of bedrooms that the town has on record.
Yeah, and that is a Cape Cod rule. So, or in that municipality, if you want to figure out what the requirements are or what the regulations are, call the town office and ask for the Board of Health, and they will tell you if there's any current regulations around short-term rentals or if there's going to potentially be any regulations, and they'll send you the paperwork of how to apply for the permit if they require one and what those rules are. I know I was looking recently in Plymouth, Massachusetts. They're all on septics. They do not have an occupancy limit requirement like Dennis does. But then, there's other municipalities like Salem where if you are not occupying the residence, you are not even allowed to rent it out as a short-term rental. So there's all sorts of different things, not something we're gonna get into deep, but it is super important. And it's important to either work with a real estate agent who understands what those regulations are, or if you need to yourself, call the town before you start putting offers in on homes, just so you cover yourself.
All right, so then with that, if the town does require it, then they know that you are actively advertising and renting your property on Airbnb or VRBO. So it's in your best interest to make sure you pay your taxes. As I said, Airbnb and VRBO do make this easy for you. So I think at the very beginning of setting up our listings, we had to fill out a tax form and put our social security numbers in and everything. And then that helped trigger the payment processing and remitting taxes for us. So I think that on VRBO, for our first day or two, we had never got the money deposited into our bank account because it held it up until we finished doing this tax form. So they're really diligent about making sure you get that. So that's great. And then when you have your first bookings, double check the breakdown of that customer's payment to make sure that it shows the remitted taxes in there. I still look at that because I have to do some monthly paperwork for Dennisport, which I'll go into in a second, but I look and make sure I still see the taxes being remitted and there wasn't an issue, because there could be a bug sometimes on a software and they don't do that. I've never seen it, but that's something that I'm hyper aware of working in tech, and want to make sure that they're continuing to take those taxes out for us. And then at the end of the year, we get that 1099 form mailed to us and we just put it in our folder with everything else we send to our CPA. Anything else on that?
Nope.
So yeah, the thing I'd add on Dennisport. So even though Airbnb and VRBO are remitting taxes for us, I do have to go in every month and go into the Massachusetts tax website and let them know what our gross booking amounts were. and then how much I owe for taxes. So I enter our gross booking amounts, but then I enter $0 because my customers have already paid those occupancy taxes for them. But I just put that into my process. It takes 5 or 10 minutes a month to do that. So just be mindful and follow the paper trail of what the town sends to you to make sure you're crossing your T's and dotting your I's on the tax front. All right, our last topic on forecasting and planning. So going back to that expense and revenue tracker that we have in Google Sheets that we're happy to share with you, I use that as to look forward at what our bookings are for the next few months. So we have bookings a ton in March and February now for ski season, sorry, January and February now for ski season. So I put those in there. So I see our mortgage, our expected utility bills, etc. And then I look at what our revenue is looking like for those months and can estimate out, how are we going to look for how much extra money we're going to make that we can use to help fund those emergency funds or capital expenditures. Or I look at months that it might be tighter because it's just a slower season in a particular market. So I think that that's super important to do, is to look forward as you're planning out the rest of your year. And also we use this to help provide to our CPA to anticipate how much we might owe in taxes for the net profits we get on our revenue minus our expenses. So she was the one who had 3 or 4 years ago had told me to make sure I build this out and estimate how much we think we're going to be making in June, July, August, September, October, so that we could see how much we might potentially owe. We actually recorded losses for a couple of years, so we were in, had some cushion there, but then we started earning some enough revenue that it would we were looking at potential taxes the next year. So it was really helpful to have that forecast out.
Yeah. Yep. And I mean, a lot of on paper, what you see and what happens in real life can be a little bit different, but we have tried to front load certain projects so we could recognize reductions in income for tax purposes. Just important to know, and just like the expense tracking template that we can make, this forecasting template is super easy for us to provide people as well. And if you need help, let's say you're in your first year of running your short-term rental and you want to get a sense of what your revenue might be for the rest of the year, for the rest of the tax year anyways, again, feel free to reach out. We have some tools that we can take a look at and take a look at your listing and help you at least try to triangulate that, which you might find helpful, and you don't have to pay us anything. We're happy to do that and help you out.
Yes, and again, going back to the usefulness of this for planning and wanting to do some improvements. We even were in the car on our way home from our property in Maine talking about improvements we want to make to our Cape House. So we were able to estimate the cost of those and determine, are we going to have that in our accounts that we were just talking about earlier in this podcast, or are we going to leverage some other source for those improvements? And we think that it'll pay dividends later and being able to increase our nightly rate, et cetera. So it really is valuable to have that view and not just be reactive and focusing just on your checking account and what that balance is. You really want to, if you want to get to a place where you have that extra cushion, a little bit more wiggle room and ease of mind, this really helps you just planning a little bit further out to be able to understand where you're at with your short-term rental. And I'm going to call it a business, even if you just want to own one and have it be a combination of personal and business, because it is its own little business entity.
And we all are chasing the passive investment. And what we have found is that towards the end of each year, being proactive and actively spending on some upgrades or changing out furniture that might be more maintenance free, and just trying to get ahead of a lot of things has probably helped us in the long run in terms of avoiding headaches when somebody is at a property and things going how they planned, because we planned on that proactively. And one thing we like to do is we sort of take a look at, how much money are we going to make this year, and then use that as an opportunity before the end of the year to reduce that income base by spending on some of these capital expenditures or repairs and maintenance items or just updating things. And it has always seemed to make the next year go pretty smooth, and thankfully we've never had any major things or anything like that happen or go at the house, but it does really help. So the forecasting and planning, it doesn't take a whole lot of time, but I find it to be really exciting to see how much we've made up to that point and what realistically we think we're going to make for the rest of the year. And you can see that all in these different spreadsheets that are really easy to update. And all that information you can just get from Airbnb and VRBO in terms of what you've made, what you've gotten for payouts, and you can look at your own receipts and that expense tracker we were talking about to put that income against the expenses.
Yeah, and it's cool to look back and see how far you've come. So when we were looking at our keep house to purchase, the previous owners had shared their revenue with us and said they made 18 grand a year. So we used that to estimate if this house would even just break even if we purchased it based on the mortgage we estimated, the cleaning expenses, et cetera. And we said, hey, yes, we can cover expenses. We should do this. We'll get an awesome asset and a free vacation out of the deal. We've been able to go expand way beyond that. And it's been exciting to see how every year we've gotten better. Either we have more reviews under our belt, we're able to charge a little bit more, where we put some improvements into the house that we feel are worthwhile to justify higher nightly rates, or we've done an improvement that expands our shoulder seasons. We just replaced the heating system and put central AC with mini splits in that house. So now we don't have an ugly wall, window unit AC in the house anymore. And also we have reliable heat for the whole winter. So we've had people reach out and say, hey, can we book for New Year's Eve? And we never expected someone to want our 500 square foot I was gonna say apartment, because that's what you typically have as an apartment. Yeah, our 500 square foot cottage for New Year's Eve, but they wanted it, and we actually weren't able to accommodate since we were doing other improvements. But it's very cool to look back and see how far you've come and have that record. And that's what we have in the spreadsheet is a rolling revenue and expenses trackers going back to 2019.
And not only just kind of blowing that revenue out of the water, we've doubled the amount of time we get to vacation at the house, which for me is super important. I love vacationing at that house, and year one was a 1 week vacation. Now it's a 2 week vacation. And even 1 year we snuck in 16 days. So for us, even though we do run these as a business, we really truly enjoy using the homes ourselves. And that has been really nice that we get to spend more time down there than we ever had before.
No, you're right. It is double, because this year we're projecting a little bit over 36,000 gross. So
yeah, and we do choose to vacation
season.
during weeks when we would make a lot of money, and that's okay. It works for us, and we're happy with that. So
it's the reward you get for
that's right,
for all the work you put into it.
Any more slides?
That was it.
That was it. All right, everyone. Well, thank you so much again for joining us. Again, this is going to be, or this is up on YouTube. This will also be on the Hassle Free RE podcast. If there's any questions that folks have that they would like for us to make as a topic on our show, or we can even do like a live Q&A, we would love to have people on. We love answering questions. We love going and seeking answers and bringing them back and talking about them. So anything is on the table. We'd also love if you gave us a 5-star review, just like, how about that, right? 5-star review. If you're listening to this as a podcast, or like the video, if you have it on YouTube, and please do subscribe. We'd really appreciate it. And with that, stay tuned for next time. Thanks, everyone.